Hi, welcome to the Manage the Fund podcast. I'm Michael Carlin, president of Henry & Horn Wealth Management. Joining us today, Stefan Dye, vice president of Henry & Horn Wealth Management. Good morning, Stefan.
Good morning, Michael. Thank you for having me. Great to be here.
Oh, we're very excited. Today, we're bringing you our first quarter 2018 market outlook. We're going to give you the conflict-free, unbiased view of the way we see economic fundamentals in the stock market coming together to break down how we see all this information coming together and how we make portfolio decisions. This is an inside look as to what we do when we're managing money. But first, Stefan, why don't we start with something that you've seen recently that you thought was awesome, impressive?
Awesome, impressive. So I saw this week an interesting story about how money is pouring into the equity markets at unheard of rates. In fact, 4-week inflows into stocks in the United States especially were at an all-time high, the largest ever. And this is a combination of both institutional and individual investors just pouring it in there.
The sign of a all-time high, the sign of bearishness or bullishness at excesses, you think?
It feels a little toppy to me. As we've talked about before, I use the face of a clock to understand where we are in a market cycle. And if listeners, you can imagine the face of a clock, this feels more like a 11, 12, 1 o'clock than a 5, 6, 7 o'clock when you start seeing all-time record inflows. And the prices will go up when money pours in. Yeah. And that's what's happening.
As it has. Yeah. You know, and that dovetails into what I saw recently that I thought was super economically impressive. One of our favorites, the Stefan and I, we enjoy watching and reading is Ray Dalio. And this morning he was talking about the economy and, you know, everyone's expectations when you read a lot of the sell-side research is, well, GDP growth here in the United States is going to be greater than 3%. He was calling for numbers more in that 2.5 to 2.75 range. You know, and we're going to dive into this much deeper. But when you have institutional minds like Ray Dalio calling for 2.5%, looking at the Fed's actions for 2018, it just dovetails exactly into the way we see the market coming together as well. So without further ado, why don't we just dive in? Let's take a look at some of the numbers and the research that we think is most important as it helps guide you when you're making your portfolio decisions and thinking about your investment account. Well, last year should have been a good year for you. U.S. market, the big cap stocks, up 21%, emerging markets up a whopping 37% plus last year. International stocks, the big countries, you know, everything from Europe to Japan up 25%. Small cap was the laggard and the equity side up only 14%. But Stefan, when you go down the list, stocks, bonds of all kinds, both government, high yield, even the alternatives, the long short, the hedges, everything was working last year. It was pretty incredible.
Everything was positive. There was nothing negative, no drawdowns over the course of the year, no negative, no losses. And we like to look at what we call the global market portfolio, which is all the assets that you could buy, weighted kind of by how they're owned across the world. It's the ultimate passive buy and hold portfolio. And that global market portfolio last year was up just over 12%. Really good stuff.
Unbelievable.
Really good stuff. And then you see some real big wins. Emerging markets, 37%. They were just on fire.
Yeah, and emerging markets do tend to be volatile. So we do want to caution everyone, you know, you don't want to get too excited about emerging market performance and then just go ahead and dump a bunch of money in it. Look back historically, you'll see emerging markets have a long, rich history of going up and down very volatilely. So with that, we start to look at the base case scenario of what the market expectations are. And if we look at a lot at Alliance Bernstein's research, and they're expecting global growth to be 3.2%. I want to stop there for a quick second, is that if you look back the way we have, and we've been doing this is our 11th year of market outlooks, I can't think of a year where global expectations weren't always really high in January. I've seen a 3% global expectation for so long, and we haven't delivered those numbers. So, you know, people want to get so excited. You see this, Alliance Bernstein's calling for 3.2, but we're more aligned with like the Ray Dalio folks thinking 2.5, 2.75. We're not that excited. We're trying to move a $20 trillion plus economy, and gosh, getting a 3% growth rate here in the United States would be magnificent. We've certainly had great quarters where we've been seeing that kind of economic numbers come through, but I don't know. I'm not feeling quite as confident as maybe some of the other sell-side analysts are.
Well, you're not the only one. And for those of you listeners who don't know, Ray Dalio is the manager of one of the largest hedge funds in the world and one of the most respected voices in forecasting in the world. And the Davos meeting that Michael is talking about is one of the meetings of the best minds in economics and finance and global politics all over the world every year.
Right.
And yes, you're right. I mean, it seems pretty optimistic. 3% growth. Dalio talking about it more likely in the twos. I'm feeling the excitement. I think a lot of times economists will project out what's been happening recently, and they have an optimistic bias, and they just had a good Christmas. They're feeling good, and they're putting out some big numbers. At the same time, things have been going pretty well.
And let's also not forget, hate to be a little negative, but AllianceBernstein and those folks they're sell-side research. The reason why it's called that is they want you to buy their funds. They want you to buy their optimism. So again, we're trying to see through the facts. We're trying to see through the data, bring it to you straight. What we do like is we do think inflation, which has been low, should continue to stay low, which is great. Coincidentally, Ray Dalio thinks the same. And neither he nor I are afraid of a little bit of inflation. That typically is a good thing for wages, which we'll talk about a little later, which have been better. Fiscal policy is good. We're going to talk a little bit about how the tax plan is helping the economy move forward, helping the stock market. And if you're looking at central banks have been key and vital to creating this market environment that we have. It's been easy money. It's been cheap money. You've had Federal Reserve Bank here in the United States buying assets of all kinds. You have European Central Bank and the PBOC in China. You have all these different institutions that have been doing their own buying as well that supports the market in all sides. We're starting to see that punch bowl dry up. Certainly here in the United States with interest rate increases, we're starting to see the same thing globally. That has to start to be a bit of a detractor moving forward.
So the single most important factor for the run-up since the global financial crisis has been the liquidity that the global central banks have provided. Right. They say they don't work in unison. I don't believe that for 1 second.
Me neither.
Yeah, I think they're on the hotline to each other, the speed dial to each other, and they're coordinating. And the U.S. Federal Reserve Central Bank will indicate that they're going to start to pull back, but then Japan will ease. Germany will ease as Japan pulls back. But the global liquidity has continued to grow and grow. It's flattened a bit, but we haven't yet seen much signs of them pulling back the coordinated efforts, but they're talking about it.
Right.
And the what keeps me up at night when I'm worried about stock markets is what are the central banks going to do? And when the global liquidity begins to dry up like you're talking about, that could mark the turn in the stock market.
Right. And so for those of you who are looking for a key and a signal, look for the Federal Reserves all over the world to be talking about what their monetary policy is going to do. Are they easing? Are they making things a little bit more tight? I want to switch gears. Let's talk about consumer confidence and business confidence. Two great data points. The survey of consumer confidence, not quite at an all-time high, but my goodness, it hasn't been this high since the dot-com bubble in the late 90s. Small business confidence equaling all-time highs. So to me, I see those signs as great supporters of our current economic growth. I see it as great supporters of our current stock market environment. Meaning those high measures give credence to explaining why the market's so high, but it doesn't help make me feel better about the market moving forward, because to me, I look at those measures and say, well, goodness, if it's at or near all-time highs, is there only one place to go?
Yes, and I think what you're describing fits with where I started about the record bull run in equity flows. The money's people are confident. They're feeling good, and I divide markets into a simple kind of 4-quadrant box, and the best markets are the ones that are inexpensive and going up. That's the one I want to be in. And the worst market is the one that's expensive and going down. that's the one I do not want to be in. And of course, the second best market is the one that's expensive and going up. That appears to be where we are right now. And I worry a little bit. So I'm with the public, and we're invested, we're enjoying the ride. The trend is up, but it seems like things are getting pretty expensive, and you're seeing both bonds and equities appearing to be pretty pricey, and the high valuations in equities, especially. If you look at one of my favorite measures, it's price to earnings adjusted over a 10-year average. My hero is Professor Schiller at Yale.
I know this. Yep.
Yeah, I talk about it all the time. I'll drive you crazy with it. But historically, you could get some pretty good information about what's going to happen in the future with prices. And the United States market is near all-time highs.
Right.
One of the most expensive markets it's ever been by almost any measure that you look at. And when you look forward 10 years from these market valuations, typically you'll see something like 0 to negative returns over a 10-year period.
Right.
So we're in this great market. It's the second best market to be in. It's expensive and going up. But when it does turn, as we think it will at some point, this is one of the longest bull runs in history. It can't go forever.
Second longest, yep.
Then we'll be in the worst box to be in,
right,
which is a very expensive market going down. So I think it's the key, I think, right now is to be aware of where we are, to have a plan,
right,
to know how you're going to know when it's time to maybe take a little bit of risk off the table, and then not get your emotions involved and get too scared too early or get too greedy right now.
And we're happy to share these charts, these graphs, because Stefan's specifically speaking about the CAPE measures and different high valuation modest return graphs and charts that we have. And you can certainly send us an email to info@hh-wm.com, and we're happy to share these graphs and charts with you. Just let us know. So you're right, and the valuations are tough, but there's still good economic data out there. You got wages and spending. Wages and spending. Key to the way our whole economy works from the perspective of we are still a consumption-based economy. That isn't going to change.
That's right.
And we need people working. We need them earning more so that they can spend more. So we focus on wages. And interestingly enough, the stock market has exploded up, really. It's done great since 2009 March, and had a great 2016, great 2017, great start to this year. And if you look, the wage increase really falls hat in hand. When wages started to increase, that's when the market really found a whole second leg to drive it forward. So again, another positive economic fundamental, wage growth, terrific. And this helps middle class households all over the United States. Certainly supports our stock market where we are now. But again, is this the kind of thing we can get excited about moving forward? Is this going to continue to drive the market forward? And this is where we think valuation starts to play a part.
So you're totally right. Wonderful for employees to have more money to spend. 70% of gross domestic product comes from consumer spending. You think you're going to have better GDP if you have more spending.
You got it.
I saw something interesting this week, which is just in from the St. Louis Federal Reserve Board. And they're showing that employment change for those 55 and older, since 2000, if you remember the market correction in 2000, folks 55 and older have been more and more employed. So call it 17 million more employed 55 and over. But at that same time, in about 2007, during the Great Financial Crisis, those under 55 employment began to drop and started recovering in 2011. But the gap between the two is really wide. So what's happening is older Americans are working longer, and younger Americans are having a harder time finding a job relative to the older ones.
Right.
And I'm just sort of aware that sort of the 55 and older group has a tendency to spend less than the 55 and under group. So I think that's something interesting to watch as we figure out how employment and wages are going to rise. And the other thing, the concern I have about wages rising is that the central banks are going to be watching those wages rise, and that's when they're going to have a tendency to pull back on their balance sheets.
Right. And they tighten, they raise the short rate they're expecting for this year.
And that's right.
For interest rate increases.
They say we're going to reduce the amount of money in the system, and that's when the stock market could begin to, wobble.
Yeah. Well, yeah, and we got to talk about the flattening yield curve. We got a lot of stuff to go through. If we've got time, let's go back to it. But let's talk about more fiscal activity. Let's talk about the Tax Cut and Job Act. How do we not mention the Tax Cut and Job Act? That was mammoth. There were times in 2017 where I felt that the market was so hopeful that it was going to happen that it was rising in expectation of that event. For a good part of 2017, the middle of the year, towards the end of the year, it started to feel like maybe it wasn't going to happen. And then it did. And then it did in a big way. So what we're seeing in the expectation is that the net cost in offering this individual and business tax reduction is about $1.5 trillion expected cost to the U.S. government. And there's hopes and expectations. The CBO does progressive scoring where they hope that we'll get enough economic growth to help offset some of that $1.5 trillion. But man, what a shot in the arm that Tax Cut and Job Act has provided the stock market and the economy.
Absolutely. And it's hard to know whether the market has priced in properly. Have they overpriced in the benefit? Have they underpriced in the benefit? But absolutely, more money in the economy is better. You see Apple making moves, making noises about bringing back what's the number? $250 billion they're talking about bringing back.
Yeah, repatriating foreign dollars. Yeah, held in
right,
which would be incredible. It's just my issue is that yes, we're going to repatriate these foreign dollars. It would be one thing if we knew it was going to be creating jobs or building factories or paying dividends, but the expectation to many is it will be doing share buybacks and things that will be fairly invisible to economic growth. Good for shareholders, good for the stock market, but potentially not necessarily great for economic growth, which if you're the Congressional Budget Office and you have to do this dynamic scoring and figure out, man, with these hundreds of billions or potentially trillions of dollars coming back from overseas, what's the economic impact going to be? I would get more excited about it if there were more companies, and there have been some talking about hiring, talking about building and growing. I haven't seen as much as I'd like to.
Yeah.
Right.
I'll be honestly happy to see my after-tax income a little higher. I'll get to keep a little bit of money myself. And that's I'm happy about that part.
Absolutely. Well, so we'll take everything we can get.
Right.
Last economic data point, volatility. So volatility, the measure there is how much is the stock market going up and down on a daily basis? There have been pockets in periods of time, and we've got great data that we're going to share with you at the end of the podcast when we talk about conclusions, which will take a deeper dive into volatility. But Stefan, the amount of volatility is just ridiculously low, and it can lull investors to sleep, I feel.
It's amazingly low, and if you only looked back over a 12-month period, you would think that the stock market only goes up.
Right, exactly.
It never goes down. For 12 months in a row now, we've had a higher stock market price here in the United States every month than we did the month before. In fact, that's only happened a few times in the history of the country. The only longer time was in 1958 to 1959, where it did it for 15 months. So a couple more months of this, and it will be a record. And just
it lulls investors to sleep, thinking I can't lose. I'm just going to keep putting money in the market. I'm not going to worry about it.
And so you see record inflows,
right,
to equities, and people are very excited. It's a fun time to be in the market.
Yes. But hopefully it's a little bit of a nerve-wracking time too, because we want to provide the realistic expectations of what to think about the market moving forward.
That's right.
Every market outlook for 11 years now, we do special breakouts. So we do talk about markets, fundamentals, things like that. why don't we switch gears, Stefan? You have a decade and a half career with one of the largest energy exploration companies in the United States. It would be great if we could talk about the rebound in oil prices. I think that'd be a great special aspect, and we'll talk about for this quarter's special. We'll do oil, and let's do some renewables, some solar as well. So why don't you spend a few minutes telling us what you've seen in the oil market?
Sure, you bet. So we could get stuck in oil prices for a long period of time. It's a rabbit hole we want to be careful with. But I think the oil story is really a technology story. For those of you who don't know, what's happened in oil is two technologies converged to open up a bunch of oil in the United States that was previously inaccessible. And in doing so, changed the dynamics of oil prices all across the world. Because oil is a global commodity, you have to pay attention to what's going on the supply side and the demand side all across the world. But what you've seen is OPEC is trying to control the price of oil.
OPEC being?
OPEC is the Organization of Petroleum Exporting Countries, and it's led by Saudi Arabia, which is the largest producer and the most important member of OPEC. And now Russia has sort of informally joined the coalition. And they agree to limit production or increase production in order to manipulate prices. And right now, OPEC is saying that they're going to continue their production cuts into 2018. And we see oil prices are rising and staying strong. We've seen oil prices drop from $105 in July of 2014 down to a low of $26 in February 2016. And then we've had a real run recently off of lows about $45. And last year we've seen a real run in oil prices. I think most prognosticators think oil should be in a range between 40 to 60 in the United States. There's a premium in Europe right now. The price of the Brent oil as opposed to the West Texas Intermediate is a little bit higher. It's about $6 higher. We think that those will begin to converge probably in 2018.
So here's a question for you. So do you think that oil prices being in that high 50s range where we are today, do you think it's because of Saudi Arabia's, OPEC, I should say, their words that they're going to cut, or do you think some of it has to do with demand? Or combination?
I think demand has been high, and demand remains strong. Surprisingly, supply though has just been really strong as well. The number of variables that influence the price of oil is astounding. And we can focus on OPEC, we can focus on shale, but then we still leave out many, many factors that are really important that most people can't see. They're invisible to us. So I think the good thing to do going forward is to assume a 40 to 60, 65 kind of range. And there's a possibility it goes much higher. There's a possibility that it goes much lower, but probably in that range is what
because
we'll see.
Demand's fundamentally high, and Saudi Arabia and OPEC saying the right things about their supply side in terms of feeding the market.
The demand is strong and supply is strong.
Right.
The supply has been rising at a dramatic rate, largely in the United States. It's due to the two technologies that have converged here to make the shale. Natural gas, we're talking about energy.
Right.
And you just go to a more broad look at energy. I think it's interesting. The Energy Information Association does a short-term energy outlook every quarter. And their most recent outlook says that total fossil fuels production, which is oil, gas, coal, natural gas liquids in the United States, will be the highest production level on record ever in 2018.
Wow.
And they're saying it's going to be the highest in 2019 as well. And they're saying most of the growth over the next 2 years are expected to come from the shale oil production that we've talked a little bit about and from higher natural gas production. And natural gas, what you've really seen is a shift to more natural gas uses to create electricity as coal becomes less and less preferred. And we just have so much natural gas. And those same two technologies that converged to open up the oil did the same thing in gas just before.
Fracking and what have you.
Fracking and lateral drilling. You're
Right.
able to drill down and sideways now and then break the rocks up, and it releases the gas.
We're going to need to do a podcast on fracking.
A fracking podcast.
I think we do. I think we need that.
Would we call it the Fracking Podcast?
I think there's no better name than that. So it's, the production is certainly not coming. Energy is certainly not coming from coal. We see that coming offline more and more. And one of the things I do is I translate, that information back into the stock market to say, okay, so energy prices going up, how much is that going to continue to move the market higher? Because it wasn't all that long ago, it was really 2008, where energy companies, just even within the S&P 500 alone, made up about 15, 16, almost 17% of the total S&P 500 were energy companies. As Stefan said, prices for oil went down significantly, down to as low as 26 at one point. And today, energy companies only make up 5.8% of the S&P 500. So I put this information together to say higher energy prices at one point was hugely important to the stock market moving higher. Higher energy prices today have less of an impact, and I think it has a lot to do with the fact that the S&P 500 isn't made up of energy stocks the way it used to be.
The way it used to be. Yeah, exactly right. So it's not going to impact the S&P as it would have in the past. And so the other thing that we're talking about in talking about oil prices is the U.S. dollar. And usually the dollar, when the dollar rises, oil prices will fall and vice versa. They work opposite to each other. And in 2017, interestingly, both the dollar rose and oil prices rose. So
right.
It's an interesting time to see what happens with those two and how the market reacts.
Right. Yeah. We've got that we're gonna have to see how it plays out. But that linkage between high energy prices and high market, I just think is at least partially broken, as explained by the amount of companies that make up that part of the S&P 500 index. Why don't we switch gears, talk a little bit about the renewables, the solar. I sit on the board of a large solar utility company here in Scottsdale, Arizona. So I got a few perspectives on it. It's increasingly important that we have this conversation because solar has created virtually more jobs by sector than any other part of the U.S. economy that I'm aware of. Hundreds of thousands of high-paying U.S. jobs have been created in that solar marketplace. So I was surprised to learn that the tariff, which is Section 201, that recently, just as of yesterday, when we're recording this, got approved. That the tariff did go through, and it's surprising because the administration is charging a premium now for imported solar panels. There was a lot of fear and anxiety in and around the solar marketplace that this tariff was going to be crippling, that it was going to increase the price of solar panels to such a degree that it would make the cost for building these large utility scale solar projects all across the United States that have created so many jobs, it would make those costs unreasonable. And that's been part of the whole solar story. The reason why it's come online is not necessarily because people are all of a sudden more green. People do like the idea that the sun goes up, sun comes down. I don't have to burn anything in order to create energy. I get that, but it's the economics of it that I want to talk a minute or two about with regards to solar that has made it so innately important to our acceptance of it and our future use of it. And in fact, if you look, solar costs down 80% since 2009.
Incredible.
Yeah.
Incredible.
I mean, some of that's Moore's Law, meaning, again, as technology improves, the cost for things go down, and then you get better use of of whether it be a microchip or in this case a solar panel. And the amount of solar, as the costs have gone down 80% since 2009, installed solar is up 1,000% since 2009. Again, it proves the point to me that solar is working largely because of the economics to support it.
to me, just as a quick aside, this is a fascinating topic because if you look at the history of energy use, there was a period where humans used wood to create energy, and they built technology in England and other places to use that wood. Then we discovered coal as a species and decided to use, there's more energy in the coal, and we switched over and used it. Then we had all this coal infrastructure, and we switched to use oil, which has got a lot more energy per unit of weight.
Yeah.
Now we're switching again. We're right in the middle of a transition from coal to oil to now solar and wind renewables.
Right.
And my experience has been largely on the oil side, raised nearly $1 billion for offshore oil drilling in the Gulf of Mexico. A lot of my personal holdings are in oil in the Gulf of Mexico. Your experience on the solar side, I'm sort of the old and you're the new.
Don't take it personally. Don't take it personally.
I'm on the wrong side of history here.
Well, I look at it, it's 2016, percent of global energy output, 2% of it was solar. At a reasonable rate of increase that what we're seeing moving forward, even including the tariff that was just put in place, by 2040, the International Energy Associate, Oxford Club, Bloomberg, BP, they all assume that the numbers are going to be about 34% of global energy output will be from solar. And I look again back at that fundamental cost, and Lazard has a really nice chart that I look at where the information's a little old, but it says here that the utility scale solar cost 5 cents per kilowatt hour. And you compare that to rooftop solar, and that's one of the things we think solar, oh my gosh, rooftop solar, does this mean it's time? No, rooftop solar is still way too expensive. At the time that this was printed by Lazard, which I believe was last year, rooftop solar was 18 cents, more than triple the cost of that big utility scale solar. Utility scale solar, meaning these big 100 megawatt plants where it's taking up countless acres and sending the energy into the grid. So again, 5 cent utility scale solar compared to 18 cent rooftop. I don't think that we're in any risk of seeing lots of rooftop solar anytime soon, although I do think it's coming. We'll talk about that in a future podcast, I'm sure. And you compare that to even wind. Wind, on an unsubsidized basis, is at 6 cents a kilowatt hour. Utility scale solar, 5 cents. And right now, I can tell you utility scale solar is really at 4 cents. We've seen a pretty big improvement there. But compare that to natural gas, 8 cents. At peak natural gas, where natural gas is really expensive, natural gas was as expensive as 21 cents.
Right.
Coal, 14 cents. Nuclear, 18 cents. So if you're comparing 5 cent or 4 cent utility scale solar, just on a pure cost basis, why would a government, why would a municipality, why would a business look anywhere else other than the most cost-efficient solution that's available?
Well, I think you know the answer to the rhetorical question.
I do.
It has to do with established interests and infrastructure already available, but the transition is happening. We are moving to a solar, wind, renewable powered footing in this economy. It's a wonderful thing that we're doing that.
Have you seen, we got to talk about this more, but have you seen there's really good use of natural gas to power solar plants at night, kind of that combination. And it's amazing because of the efficiency. Many thought that utility scale solar was going to be solar plus battery. We're seeing it's actually solar plus natural gas to create this 24-hour a day reliable energy source into the grid that is way less expensive than the norm.
That's terrific. Yeah, terrific. It's just terrific. Yeah.
So in conclusion, I think we need to we got to wrap all this up because we have unpacked U.S. economic data about wages and jobs and economic moves that the government's making here and overseas and market performance. What everyone's really looking for is what to do next. So, do you want to start? You want to start? Want me to go take them
Sure.
through?
Well, I like this thing we talked about. So I'd like maybe we'll share. What am I expecting?
Yes.
What am I hoping for, and what am I worried about? It might be a good sequence.
Perfect.
And I think the in the markets, which what we care about the most here, I think the global market portfolio that we talked will continue to perform well. That's what I'm expecting. It did what was it, 2.8% in the fourth quarter.
Right.
I'm expecting something like that in the first quarter of this year. Maybe it'll be 2.8% in that range. What am I hoping for? Mm-hmm. I'm hoping for just that, because that's a wonderful number that is potentially sustainable. And what am I worried about? I worry about central bank liquidity at some point beginning to dry up a little bit, and the stock market's going from expensive in an uptrend to expensive in a downtrend.
Right.
I don't think it's going to happen this quarter. It's not what I expect, but I do have our antennae are up and out, watching for any indicators of a turn.
Okay. Well, so I'm expecting something somewhat similar. I'm expecting, because of all the economic and fundamental data that is solid, and although, consumer confidence, as we talked about, and jobs and wages, all those things seem to be improving and they're at highs. Again, they're not going to turn on a dime. So I do continue to believe that we're going to see this market move and lurch forward, because the economic data justifies it. The economic data supports that. So I'm good there. So I hope and expect that. But what I'm worried about is this last piece of data, this last chart that I teased probably 10 minutes ago, and that is, it's the "are we due for a correction" chart. No one knows, right? But here's the data. It's been 77 weeks, 78 weeks now, since we've had a correction of 5%. And that's significant, because we typically have it. And this is data that goes back from 1928 to the present. We typically have a 5% correction every 10 weeks. Okay. Well, it's been 96 weeks since we've had a correction of 10% or more. We typically have those every 33 weeks. It has been 445 weeks since we've had a correction of 20% or more. We typically have them every 127 weeks. So, what am I worried about? I'm worried about reversion to the mean. I'm worried about this bull market run that we've had, that is the second longest ever, runs out of juice. Now, Stefan, as you pointed out, is it going to be due to the Fed pulling away the punch bowl, increasing interest rates 4 times this year because there is good economic data, and that makes things a little bit more tight, slows down economic growth? Possible. Is it possible that this tax cut relief act that we got was the last fiscal policy move that we could that pushes our market higher? Maybe. Is it the fact that everyone's talking about Bitcoin and equities and people dumping in the market? Maybe. But we're seeing a lot of signs of market top, and we are saying this is the time to be cautious, reevaluate your portfolio objectives, and think big picture. We're not doomsayers by any stretch of the imagination. We are talking about how the markets perform well. We both expect it to continue to move forward. We do see good signs of economic recovery and economic growth in lots of different areas of the market. We see good things with solar and good things with oil. All that notwithstanding, mean reversion is real.
Mean reversion. And for those of you who don't know, what mean reversion is, what he's talking about is prices have an average price over a period of time, an average level of expensiveness or inexpensiveness. And when prices go through the average, they extend above or below, eventually they'll revert to the average, and typically go from above the average to the average and below the average, and then back up to the average and above the average. We're just way above the averages right now. The prices are way above average prices in history, and he's saying, I'm worried that we'll go back to the average, and also the valuations are way above.
Listen, if LeBron James averages 27 points over his whole career, points per game, that's his average, and if he has a month that he's averaging 39 points a game, I don't all of a sudden believe he's a 39-point-a-game scorer. I think at some point there's that mean reversion, and he goes back to averaging 27. Well, that's it, Stefan. This was fun.
That was terrific.
It's a good time.
I enjoyed it.
So thanks again for tuning in. Look forward to our next podcast at the Manage a Fund podcast. This is Michael Carlin and Stefan Dye from Henry & Warren Wealth Management signing off.